Good afternoon. I'm Robert Shappee, and thank you all for coming today. We're going to talk about tax reform and a few of the impacts that it's having on the construction industry. And more importantly, some of you in your business are probably going to see some changes as to the way that we're being taxed. So let's begin. I put in here the actual name of the Tax Reform Act. It's very long and arduous name, but signed by the President on December 22nd. Most of the provisions go into effect on January 1st, 2018. Some of them are back into 2017, and so we'll go through those a little bit just to make sure you're aware of any changes that might impact this year's tax return. A few individual provisions, I just wanted to add those. I figured there'd be lots of us in the room that were kind of curious about what happened on the individual side, so I just wanted to make sure that you kind of got some of that information too. So on the individual provisions, we basically have had rate reductions and bracket changes. So it looks like across the board we're having anywhere from a 1 to 3% reduction in the tax bracket tax rate itself, and then most of the brackets have been expanded. Some have moved up, some down, so there's a little bit of a change there, and you'll just have to, as those things come up throughout next year, you'll see where those actually land. As you'll see later on, taxable income is a number that is moving right now, so we're still kind of learning more about this bill as things get written, but these are some of the major provisions. So there's on the individual side, we're going to increase the standard deduction. So married filing joint, you're going to go from $13,000 to $24,000 on your standard deduction. Single, $6,500 to $12,000. So you'll see some tax relief there, especially if you were claiming the standard deduction prior to this. If you were not, you may actually claim the standard now, given some of the things that have been limited on the itemized deduction side. So standard deduction increased. Personal exemptions repealed. So for those of us that are claiming personal exemptions, basically the amount went from $41.50 per dependent to 0. So if you had, say, 3 dependents, that was about $12,000. You're going to lose that deduction. However, they did increase the standard deduction in this, as I showed in the slide before. So, alternative minimum tax was retained. So many of us in this room, especially in construction, we deal with having to comply with AMT on a regular basis. So on the individual side, AMT has been retained. The exemption amount was increased so that fewer of us will be subject to alternative minimum tax. The married filing joint exemption was increased from $86,200 to $109,400. So that is a small increase. The phase out amount was increased also to $1 million. So that will have a positive effect on most of us. So, and if anybody has any questions, feel free to ask. We can talk about whatever your questions are at that point. So individual provisions, still a few more things here. Child tax credit was increased to $2,000 from $1,000. So I think that was one of the provisions that was at the last minute they were negotiating about, but they basically gave us some tax relief for those individuals that are claiming the child tax credit. Charitable contribution limit was raised. So the contribution limit prior to the act was 50% of adjusted gross income. That's been raised up to 60%. Miscellaneous itemized deductions were eliminated. So anybody that's claiming, unreimbursed employee expenses or, investment expenses, tax prep fees, any of that's all been eliminated. State and local taxes limited. So there's a limitation on the amount of state and local taxes that you'll be able to deduct on your Schedule A. Mortgage interest limited also, and home equity interest has been eliminated. So if you have a mortgage that the monies was not used for acquisition or improvement of your principal residence, then you will not be able to take a deduction for the interest on that loan. The PEAS limitation was suspended. So PEAS limitation is where itemized deductions are limited based on your AGI. PEAS was eliminated back in early 2000s, and then it came back with a roar. Many of us got caught on that, and we ended up having to not get as big a deduction because of the limitation. So PEAS limitation's been suspended, another positive effect. Medical expense threshold was reduced. So those of you claiming medical expenses, and this is all really in an effort to eliminate itemized deductions, in my opinion. So qualified bicycle commuting exclusion was suspended. I had to stick that one in here for everybody just to make sure. And the exclusion for moving expense reimbursements was suspended. So last of the individual provisions. So let's get into the corporate and business world. So right off the bat, when we're talking about C corporations, basically the corporate rate was reduced from 35% to 21%. It's effective 12/31/17. Now, for any of you out there that are fiscal year taxpayers that have year ends that span over the calendar year, the rate will go into effect on 1/1/18, and you will bifurcate your income during the year and calculate a blended tax rate based on the amount of income that comes after 12/31/17 and the income that comes before 12/31/17. This will provide a real benefit to those of you that had years beginning in 2017 that end in 18. Because you'll get the benefit of that reduced rate while still maintaining some of the benefits of old tax law. So corporate alternative minimum tax was repealed, and prior year minimum tax credits are refunded equal to 50% of the excess of the credit. The amount of the credit allowable for the year against regular tax liability. So we're going to see a real benefit there for those of you that are carrying forward any AMT credits. Lower taxes on pass-through. So most of us in this room are pass-through businesses, and we're taxed on our business income on our individual tax returns, and that's really where we're going to see this 20% deduction. So the bill creates a deduction available to pass-through filers of 20% of qualified business income. So this is a pretty complicated provision, and we'll have to go through it here. I've got a few more slides here with some information about what constitutes qualified business income and how we're going to qualify for that. So qualified business income includes the net amount of domestic qualified items of income, gain, deduction, and loss. Oh, should have had a comma there. And with respect to the taxpayer's qualified trade or business. Qualified trade or business includes any trade or business other than specified service trades or businesses or performing services as an employee. So basically they carved out personal services and said that if your business is one of a nature that your income is generated by either your reputation or performing services, you will not get the 20% deduction. However, they did give us a threshold amount before that kicks in, and we'll go through that here in just a second. Limitation. So the 20% deduction is limited. That portion of the deduction attributable to the 20% of the taxpayer's qualified business income cannot exceed the greater of 50% of their share of W-2 wages paid with respect to the qualified business income, or there is an alternative to that, where you can calculate 25% of your share of W-2 wages paid. Now, this is the entire amount of wages that the business is paid based on the amount being allocated to you, plus 2.5% of the unadjusted basis of qualified property, determined immediately after its acquisition. So this, essentially what the bill is trying to do is to promote, one, hire people, number two, buy stuff. And so they're giving you the either or. It is the greater of those two amounts that it cannot exceed. So 50% of wages is pretty easy to calculate that. On the 25% plus 2.5%, it's 2.5% of the unadjusted basis of qualified property determined immediately after its acquisition, as long as it's still within its depreciable period. So, and it's the unadjusted basis immediately after acquisition. So it's basically purchase price, and you get that for the entire amount of the period that it is in its depreciable period. So that could span for several years depending on the life of the asset, determined based on the depreciation table. Specified services, so this is back to the people who are excluded from the 20%. Specified services means any trade or business involved in the performance of services in the fields of health, law, accounting, actuarial, thank you for accounting, performing arts, consulting, athletics, financial services, brokerage of any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees or owners. So kind of gives you a clue there. Two things that you do not see in that list: you do not see architects and you do not see engineers. They were specifically carved out of this definition, and they are entitled to take the 20%. So apparently they had very good lobbyists because they got the deduction. So good for them. There is an exception to the specified service rule and also to the W-2 rule. So any business that has it's any business where the taxpayer's taxable income. So this is measured on the individual taxpayer's tax return. As long as their taxable income does not exceed $315,000 joint or $157,500 for single, they are basically able to take the deduction, whether they are a service business, and that is with no W-2 limitation. So as long as your income is below those levels, and this is measured at the shareholder level. So basically, we believe, we don't have 100% of the information yet from IRS, but we believe that partnerships and S corporations will calculate the qualified business income. They'll calculate the W-2. They'll calculate the 2.5%. They will then give that information to the shareholder, who will add it to their personal tax return. If their personal tax return has $315,000 or less, they will not have to worry about any limitation or any service exclusion. If it's more than that, up to $415,000, there is a phase-out period. Above $415,000, the full rules kick in, and if you're a service business, there's no deduction, and you're subject to the W-2 limitation. So it's kind of a good little benefit for small business. Service-type businesses are probably going to try to figure out ways to get their income under that limit so they get the full 20%. Carryover losses. So Section 199A, which refers to the pass-through deduction, provides rules regarding the treatment of losses generated in connection with this qualified trader business. So if QBI at the end of the year generates a loss, that loss gets carried forward to QBI in the subsequent year. So you won't be able to take a huge loss in one year and then the next year be able to take the 199A deduction. It will carry forward and offset that next year's QBI, and you'll be limited in the amount that you're able to take. Domestic production activities deduction. So this is our old DPAD deduction that many of us were taking. This is for construction of new or substantial remodel. Section 199 provided a deduction equal to 9% of the lesser of the taxpayer's qualified production activities income or taxable income. So effective for tax years beginning after December 31st, 2017, no more DPAD deduction. So that is 100% gone. The interesting thing about this is we believe that if you're a fiscal year filer, because it uses the specific wording effective for tax years beginning after, I think that you will be entitled to DPAD if you're a fiscal year filer that has a year beginning prior to December 31st, 2017, and you will get the added benefit of the lower corporate tax rate. So there is a potential opportunity there if you're a C corporation that you have a fiscal year that you'll be able to get both of those benefits on the same return for that one specific year. Changes to the depreciation of commercial assets. So the bill eliminates the separate definition for qualified leasehold improvement, qualified restaurant, and qualified retail improvement, lumps them all together, gives them a 15-year recovery period, and that is significant because when they expanded bonus depreciation, these assets will qualify for that, and so that expanded bonus depreciation from 50 to 100%. The bill also expands the definition of qualified real property to include improvements to non-residential real property, including roofs, heating, ventilation, air conditioning, fire protection, alarm systems, and security systems. This is going to be a big benefit for several of our real estate friends, so they will be able to use that to their advantage. The expansion of 179. So this increases the amount companies can deduct in purchases from the current ceiling of $510,000 to $1 million, and increases the phase-out threshold to $2.5 million. This is going to ease the tax burden of financing investments. After 2018, the amounts are indexed for inflation, so we'll see a different level every single year for 179 going forward. It'll keep our friends in the software business happy as they push out updates every year. So temporary 100% cost recovery of qualifying business assets. So the bill increased the amount companies can deduct for assets acquired after September 27, 2017 and before January 1, 2023. This is our good friend bonus depreciation. So bonus depreciation is also been expanded to include used property now, so it doesn't have to be original service. You'll be able to get that deduction for essentially any equipment that you purchase, as long as you do it during the appropriate dates. So September 27th is great. That gives us some flexibility on our 2017 tax returns, and any assets acquired after that date can be used towards that deduction. So after 2023, the deduction phases out, and until it's essentially completely gone after 2026. So limitation on interest deductibility. So 163J governs interest deductions for businesses and partnerships. Basically caps the deduction on interest expense to interest income plus 30% of adjusted taxable income. This could have a significant effect on some companies, especially if they're not taking advantage of the full expensing provisions. So, and this was effective for taxable years after 12/31/17. So could be if you are a heavy user of interest expense, you might want to check to make sure that it does not exceed 30% of your adjusted taxable income. So there is a small business exception for that interest deductibility also. And so if you're underneath that limit, you'll be able to take the full amount. So the exception is 25 million. So any taxpayer that has annual gross receipts under 25 million will be able to take their interest in full. And a couple other exceptions there, regulated utilities and farming businesses. One thing that we've been used to for several years now is carrying back net operating losses to recognize some cash flow immediately on those losses. Basically eliminates the use of a net operating loss carryback. Generally, all NOLs going forward will have to be carried forward. There is no expiration period, so they don't expire. However, you are only able to use 80% of, or you can only offset 80% of your taxable income. So you'll always have some taxable income on your return, and that NOL will just have to carry forward until you use it all up. 1031 like-kind exchanges, only for real property now. I know several of us in this room like to buy lots of equipment, and we usually exchange that. So we're going to be restricted to only be able to do like-kind exchanges for real property. And that was another revenue raiser in the bill to make sure that we were paying tax on any gains in property. Limits on mortgage and property tax deductions. I know this is mostly an individual provision, but I just wanted to go over it a little more in depth. The new legislation only permits a deduction of interest on acquisition indebtedness not exceeding $750,000. So traditionally that number was $1 million, so we've lost interest deduction on about $250,000. Repeals the additional interest deduction for home equity indebtedness, so that number was capped at $100,000, and now we've lost that in full. So the debt has to be incurred on or before debt grandfathered. Under the old provisions would be any debt that was incurred on or before December 15th, 2017 is grandfathered into the limitations under current law. Taxpayers who entered into a written binding contract on or before December 15th to close before January 1st and who purchased such residence before April 1st are also eligible for the current higher limitations. So don't worry about your existing mortgage. This is just if you decide to go out and buy a new place and you're going to finance more than $750,000, you might have a problem there on that. State and local tax deduction. So the bill limits the itemized deduction for state and local taxes to $10,000 for the aggregate sum of real property taxes, personal property taxes, and state or local income taxes. Or sales tax if you were taking that in lieu of, for those of us that are in non-tax states. So the bill prohibits a deduction in excess of $10,000 for 2018 state and local taxes actually paid in 2017. So I think this was how they got the prepayment thing under control. They basically went back in and said, we're going to limit the amount that you get to deduct for 2018 to $10,000 in total, no matter when you try to take the deduction, because I know a lot of people were trying to accelerate that deduction into 2017. So carried interest. So carry from investments held under 3 years will be taxed at the higher ordinary income rate rather than lower capital gains rate. So this is, one of the things that was talked about quite a bit in the campaign for the presidential race, carried interest and the effect that it has. Essentially, some taxpayers are able to be taxed at capital gains rates on interest income as long as they held those investments for more than 1 year. Well, now they're expanding that and saying that they have to have them held for 3 years in order to get the lower capital gains rate. So this is really kind of one area that I think many of us in the room, especially contractors and anybody in the construction trade, the expansion of all of the methods of accounting, I think is an opportunity to review your current method that you're using for recognition of income on your tax return and see if there is an advantage to either changing that method now or going forward. So they're expanding the use of cash method of accounting. So raises the average annual gross receipt threshold from 5 million to 25 million for C corporations, partner or partnerships with a C corp partner, or tax-exempt trust or corporation with unrelated business income, regardless of whether the purchase, production, or sale of merchandise is an income-producing factor. This is a huge benefit. We'll be able to use, many more taxpayers will be able to use cash method of accounting, which is a nice method to use in that you really control when your income is recognized by when it's received, and you get deductions based on when you pay things. So kind of cash in hand type thing, and that's going to be a real benefit to us. So expansion of the exemption for percentage of completion method. So prior to tax reform, the threshold was $10 million, where you were required to start using percentage of completion method. This will raise that threshold up to 25 million. This is huge for some smaller construction companies. They're going to be able to use whatever method they are recognizing income on and not have to go to percentage of completion. We will still have a percentage of completion AMT problem. AMT basically still uses percent complete on construction contracts. So the key is to make sure that you have a contract that is subject to percent complete. So, take advantage of that if you can, and get those contracts to where you're not recognizing that income over percent complete. Exemption from the requirement to keep inventory. So exempts taxpayers that meet the 25 million average annual gross receipts threshold from the requirement to account for inventory. Essentially, on the inventory expansion, you'll be able to treat that inventory as non-incidental materials and supplies. And the only restriction is that it needs to comply with whatever method that you're using on financial statement. So as long as you're using that same method for your financial accounting treatment, you'll be able to use it on your tax return, and could be a real benefit to not having to carry inventory. Expansion of the exemption for UNICAP. So UNICAP is when we're required to capitalize into ending inventory any carrying costs of that inventory or costs of production. Raises the average annual gross receipts threshold from 10 million to 25 million. That is going to kick a ton of people out of UNICAP, which is going to be a very good thing. I know from just doing those tax returns, they can be quite complicated to figure out the amounts that need to be capitalized, and so this is really going to help us out in not worrying about that until you're over 25 million in sales. A few little side items as we kind of start to wrap things up. The employer's deduction for fringe benefit expenses is limited. So for amounts incurred or paid after December 31st, 2017, deductions for entertainment expenses are disallowed. Eliminating the subjective determination of whether expenses are sufficiently business related. So, no more entertainment. The 50% limit on the deductibility of meals is expanded. to meals provided through an in-house cafeteria or otherwise on premises of the employer. And deductions for employee transportation fringe benefits are denied, but the exclusion from income for such benefits received by an employee is still retained. So, or retained. So it looks like I got a weird spelling there. So employees won't have to pick that up in income. You just won't be able to deduct it either. So, employer's deduction for fringe benefit expenses limited. So for years after December 31st, 2025, the Act will disallow an employer deduction for expenses associated with meals provided for the convenience of the employer on the employer's business premises. So this is I believe it's the Google rule, or provided on or near the employer's business premises through an employer-operated facility. So disallows that deduction. It is a fringe benefit, not an expense to the company. And that is all we have. So those are just a few highlights of the recent tax reform that has gone through. Wanted to give you an update. We'll be pushing more information out as we become aware of how things will be treated as far as IRS revenue rulings and rev procs that give us more insight as to how things need to be accounted for. We'll be reviewing each of our clients' situations to see if you do in fact can get a benefit from changing your method of accounting. And this is my information. If you listen to this, have a question, feel free to send me an email. I'll be happy to answer your question as best I can. And thank you all for attending, and hope to see you in the future.